This video will help you better understand the new IBM retirement benefit account so you can see how it factors into your retirement plan. If you don't know who I am, my name is Chris Dime. I'm a certified financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. So IBM recently rolled out some new information relative to their retirement benefit account, which is replacing the 401k matching that IBM employees are used to. So in today's video, first we'll break down some of the highlights of the plan, and then we'll talk about how it actually impacts your retirement. So let's jump in. Starting on January 1, 2024, eligible employees, aka those with at least a year of service, are going to have their retirement benefits switched from a classic 401k matching model whereby IBM contributed an automatic 1% of your salary, and then they would do dollar for dollar matching up to 5%, so a total of 6% essentially being matched into your 401k. That's going away, and instead, IBM is going to be funding 5% of your salary into what they call the retirement benefit account, which is basically a pension plan. Now they say 5% of eligible pay. I'm not quite sure how that's defined, whether that's just, base salary or bonus compensation or any type of incentive compensation, not quite sure. So more to follow on that. But there will be no employee contribution needed. So as opposed to the 401k, whereby employees needed to put in 5% to get the 5% match, plus they would just get the 1% automatic, that's how you get the 6. They don't have to put in anything for IBM to automatically fund this retirement benefit account with 5% of their eligible pay. In addition to this retirement benefit account, IBM says that employees will receive a one-time salary increase, which is irrespective of their typical salary increases based on, performance and whatnot. And that one-time salary increase is supposed to offset the difference between the 1% match that's no longer being provided, right? Because if you were getting 6% to the 401k and now you're getting 5% to this retirement benefit account, that's 1% that you're missing out on. So IBM says they'll make you whole by way of a salary increase. Relative to the performance of the retirement benefit account, IBM promises that in the first 3 years of the retirement benefit account, which would be 2024, 2025, and then 2026, employees are going to get a guaranteed 6% rate of return. And then for the next 6 years, IBM is guaranteeing that you will at least receive the 10-year treasury yield with a minimum return or interest of 3%. IBM employees will receive whatever the 10-year treasury yield is. And earlier they said they would do 5% of eligible pay as a monthly credit, so I imagine they'll be using some sort of monthly marker for the 10-year treasury yield to determine how much interest to provide your pension plan or your new retirement benefit account. Now, like most all retirement plans, this money grows tax deferred, so there's no tax consequences to you as the employee as of now, but there will be whenever it comes to liquidation time. And they promise that even if the market declines, you won't see a decline in your retirement benefit account total balance. And then lastly, IBM says that this money is immediately vested and it's portable. So let's say you decide to leave IBM for whatever reason, you're allowed to take this vested balance and move it to another retirement plan, IRA, etc. We'll see what that looks like. But ultimately it's portable. So those are some of the highlights of the new retirement benefit account. Now let's talk about why this retirement plan totally sucks. Is probably not going to help you as much in your retirement planning as a classic 401k match would have. So first, let's touch on the salary increase offset. So IBM says that upon the switch from 401k matching of total of 6% to a retirement benefit account contribution of 5%, they're going to essentially make you whole, which I would imagine means a 1% salary increase. The problem is that 1% salary increase is actually a less tax efficient 1% of your compensation. Let me explain. So let's say you're maxing out your 401k, you're putting in $22,500 a year, and if you're 50 or older, you're putting in 30 grand. Well, that's the maximum you as an employee can fund into this 401k. However, the maximum that can be funded into the 401k is much higher. And that's how IBM is allowed to give you matching contributions, which can also rack and stack into your 401k. However, if they take away all that matching, well, now the only contributions going into your 401k are your $22,500 or 30 grand, and the 1% salary increase has nowhere to go. So that 1% salary increase is actually fully taxable, and you as the employer are going to have to go find some post-tax environment to save that money. So maybe you go and fund a Roth IRA if your income's low enough, or you do some type of backdoor Roth IRA strategy, which might be doable for you. However, it's not a tax deductible retirement contribution, meaning you will have to pay income taxes on that 1%. And odds are if you're max funding your retirement plan, your income's probably relatively higher than the average in the United States, which means you're probably paying more in taxes today than you otherwise would want to if, say, you bank this money for the early years of retirement between when you retired and when you draw Social Security, where your income tax bracket's probably a lot lower. It's not the worst thing in the world, but it is just a little less tax efficient of a 1%, which is, something to consider if your income tax bracket's high enough where this could make a big difference. To make it a true offset, IBM would need to increase your salary by 1% of your compensation plus whatever your marginal tax bracket is. Let's move on to another thing. So normally from a retirement planning standpoint, I'm a huge fan of the employer taking on all the risk for accumulating assets for the employee, which in this retirement benefit account seems to be the case. IBM's taking on the burden that is accumulating money inside this retirement benefit account. You as the employee no longer need to take the risk by having your money invested in the capital markets, which go up and down. On average, they go up, but they do go up and down. I also like that they're going to be guaranteeing IBM employees a return of some kind, right? For the first, 9 years or whatever, there's some level of guaranteed rate of return in these accounts, and that's nice. However, for the first 3 years of this plan, a guarantee of 6% in today's interest rate environment really isn't that awesome of a guarantee. The prevailing money market rates out there, which are liquid, cash equivalent type accounts that you can invest your money into or that you can at least set up at a bank, are paying roughly 5%. In fact, there's a lot that are paying a little bit over 5%. So a retirement plan, which is long-term money, not short-term money, that promises we're going to guarantee you a 6% rate of return is not that awesome of a guarantee because it's basically less than 1% over what you otherwise could achieve by just sticking your money in a bank account, specifically a money market account or high yield savings account. So unless we see interest rates drop precipitously, this 6% guarantee for the next 3 years, unless we see interest rates tank, is not that awesome of a guarantee, in my opinion. Then the next 6 years, where they promise a 3% floor interest rate or rate of return essentially inside this account, is basically average inflation outside of the past couple of years. So in my mind, they're basically guaranteeing, hey, we'll make sure your retirement plan at least keeps up with inflation. In my opinion, that's not that awesome of a guarantee either. So really, it's kind of just saying, hey, we're going to do the bare minimum. Congratulations. Again, not that great of a benefit. And then after all that's said and done, starting in 2034 and beyond, they're going to give you the 10-year treasury yield, probably on a monthly basis, which isn't that great because you could just literally go do this yourself and buy 10-year treasury bonds. But historically, 10-year treasury bonds are one of the worst long-term retirement investments you could possibly make. Last time I looked at the 10-year treasury yield, it was 4.6%. Again, basically money market rates out there in bank accounts. Back in 2022, that rate was actually closer to about 1.7 to 4%, kind of in that range within 2022. And in 2021, that rate was between 1 and 1.5%. In 2020, that rate was about 1.5%. And then in 2019, there was about 1.5 to 2.7%. So really not that awesome of a performing account. Now, past performance is no guarantee of future returns, of course. However, we can speculate with high confidence that the 10-year treasury yield is probably not going to severely outperform a 100% stock portfolio, which on average should yield some in the ballpark of, 8, 9, 10%. Now, where I could see this crediting helpful, other than, severe market decline, 2008, okay, you're probably going to get a positive rate of return in this account, whereas everybody else gets negative rates of return. Where this actually could come in handy is if you were, on the other hand, to go out there in the private market and buy 10-year treasury bonds, whenever you buy the bond, you lock in that rate. So if I buy a bond today, I'm locked into getting a fixed rate of 4.5% or whatever the rates are today. If rates go up tremendously and they go from 4.5 to maybe now 10-year treasury bonds, let's say it's 2024, are paying 5%. Well, if I lock in 10 years at 4.5%, that means that the next year I'll be buying 5%, but I'm still locked in at that 4.5% number. Whereas my retirement benefit account would credit me 4.5% 1 month, and then 5%, and then 5%, or however many more months that the 5% stays around. So basically, rather than being stuck at a potentially low interest rate if you were to buy treasury bonds on your own, the retirement benefit account will give you whatever the prevailing monthly credit is most likely. And that's nice because you otherwise are taking a 10-year commitment, whereas the retirement benefit account is giving you real-time feedback and real-time crediting based on whatever the prevailing 10-year treasury yield is. However, I'll let you speculate whether or not you think interest rates are going to go up massively from here over the next 10 years. I think if you survey anybody in the academic space, everybody forecasts rates either staying the same or slightly going down over the next decade. Could happen where rates go up more, so if that's the case, then the retirement benefit account wins in that regard. But again, it wins only if otherwise I would have gone and invested my retirement money into 10-year treasury bonds, which I probably would never do. At least not until I'm a couple years out from retirement. Now, the one saving grace I think that they do have inside the retirement benefit account is that they promise that your portfolio will not decline if the market does. And that's nice. That's a helpful hedge against other, volatile securities. But ultimately, the price you're paying for that security, that if the market drops, your portfolio won't, is a very, very, very hefty cost. And that cost is the opportunity cost of otherwise taking the 5% free match, if you will, that IBM is putting into the retirement benefit account and investing that into some type of stock portfolio. Personally, I'd much rather invest that money into stocks, collect my 8, 9, 10%, albeit super volatile rate of return, rather than getting a fixed, stable, essentially cash equivalent rate of return and know that my money will never go down. That's a pretty hefty cost. So why would IBM do this in the first place? Well, a lot of folks are speculating it's because they forecast what their obligations are going to be, and ultimately from a money standpoint, they got to find a way to save money. And I'm happy to give IBM the benefit of the doubt that ultimately they want what's best for employees, they also want what's best for their company and shareholders, etc. I'm not going to attribute any of this retirement change stuff to any type of malice. I think fundamentally the company's trying to do the right thing and just realizes the writing's on the wall and we got to find a way to save money. So what are we going to do? They could do a severe round of layoffs, which would severely impact people, or they could decrease how juicy of retirement benefits you have and see who sticks around. In addition, with all the layoffs happening, I'm sure they see that now is the time, if they're gonna make a change to a retirement account that otherwise might cause a mass exodus of employees, now is the time because people are afraid of losing their jobs and employees are probably gonna be a lot more sticky even if the retirement account options aren't so great. So how does this save IBM money? Well, the first easy one to pick up is that if they're gonna decrease retirement account funding by 1% to every employee, that's a ton of money that they're gonna save. So that's kind of a no-brainer, easy way that they're going to save some money. The other way they're going to probably save some money, though, is by the actual cash contributions to these retirement plans. So in a 401k plan, if I'm IBM and I promise you 6% is going to go into your retirement account, I have to make a current cash contribution to your 401k, and it has to show up inside your 401k investment statement. And that money is physically deposited in your account. However, on the other hand, the retirement benefit account, which is also known as a pension plan, does not actually have to be funded with current dollars. It's basically funded with one big IOU. Maybe they're taking the long approach and saying, most of our employees probably won't leave, so we don't actually have to make a current cash contribution to these pension plans so that they can do a big fat IOU whereby only when the employee leaves and transfers this retirement benefit account out, or they start turning this pension account into an income stream, only at that point does IBM actually have to come up with the cash to represent the current value of that account. From a cash flow standpoint, it sort of lessens the shackles on where they have to deposit cash funds. Now, IBM claims that this will help employees improve diversification and safety in their retirement accounts. And I would agree. This actually does help clients achieve a tremendous amount of diversification, and it increases the certainty that they will have some retirement assets out there, for sure. Theoretically, a client can blow themselves up in their 401k by making poor investment decisions, whereas if you get the 10-year treasury yield, you're not going to lose money. And if they guarantee that you can't lose money, that's all the nicer. However, this level of safety is definitely not something I would invest my money into for retirement if I'm in my 30s, 40s, or 50s, and maybe even my 60s. And that's because other than money that you're going to need probably in the next 5 years, you can afford to have that money invested generally in stocks and equities, and you can suffer that volatility because you have a long enough time horizon. So unless I'm 5 years out from retirement, I don't want any of my money invested in super safe, stable, low returning investments because that's just opportunity cost of what I otherwise could invest into and collect that proverbial, 8, 9, 10% return. In addition, with today's inflation and interest rates and all that kind of stuff, you probably need the vast majority of your retirement assets invested in high yielding, growth oriented securities like stocks, because that's ultimately what's going to drive you having future retirement income. Collecting basically an inflation rate of return is not going to produce much by way of assets in retirement that you're going to need for income when you stop working in your 70s, 80s, and 90s. So said another way, it would make no sense if today in my 30s I go, hey, when I'm 70, I'm really going to appreciate safe investments. So how about I take a large chunk of my portfolio and invest it into essentially an inflation-based account today? That would make no sense because I have 40 more years of growth under my belt before I have to worry about that. It makes way more sense for me in my 30s and 40s and 50s, same situation applies, to invest the vast majority of my retirement assets into long-term growth-oriented portfolios. So for the IBM employees out there, Arvind is no longer returning my calls. So if you've got his ear, let me know and maybe we can link up on setting up a meeting. But in all seriousness, let's transition to what you can control. So from a calls to action standpoint, number one, let's control what we can control. We can't control what IBM's doing with our retirement monies, but what we can do is we can examine how this retirement account change will factor into your unique retirement plan. If you work with an advisor, make sure you have a dedicated time slot. Our office is doing it in the spring, whereby you're going to examine your IBM retirement plans and see if you need to save more elsewhere or if you need to make other changes financially to make up for the shortfall. In addition, this might be a great motivator to now go back and look at your 401k security selection and realize, well, if IBM is now going to take the responsibility of the safer portion of my portfolio, maybe I can afford to be that much more aggressive and growth-oriented with my 401k investment selection. It might make sense to make some changes to those portfolios, maybe picking a later target date fund, whatever. So if that was helpful, I'll link below to some articles that talk a little bit more about this kind of stuff. But if you have further questions, drop them in the comments below, get in touch on the website. Hope it's helpful. Have an awesome rest of your day. Talk to you later. Bye.